raising money is not bad, right? If you're building a valuable company, then it needs a lot of fuel to to get to the next level where you're building value for all the shareholders. But you have to prove that, yes, I am building a valuable company. Because everybody who starts a business feels that they're going to build a billion-dollar company. But at the end of the day, the market has to dictate that is this company worth, or does this company have a potential to be a billion-dollar company or not?
Okay, Manoj, if you can take a moment to introduce your name, your company, and a little bit about your organization.
Hi, everybody. My name is Manoj Ramnani. I am the founder and CEO at Sales Intel. I'm excited to be here. So what do we do at Sales Intel? At Sales Intel, we provide data and intelligence to go-to-market teams for them to go build a robust pipeline, for them to go hit the revenue target. So that's what we do at Sales Intel. I'm excited to be here.
Fantastic. Question number one. Along your journey as a founder, you had a choice. And that choice was go left and continue to be bootstrapped, or go right and raise capital. Can you talk a little bit about your decision-making framework, which direction you went and why?
Yeah. So, I've been on this journey a few times before. Sales Intel is my fourth company. I have various degrees of successes, exits, and failures along the way. So Sales Intel, we kind of chose initially the bootstrap path. There's a lot of fun in getting the right team, trying to solve a problem and go to market. But then once you prove the product market fit, to accelerate the growth, you need the capital, right? Especially when you're a SaaS company. Services companies, you can grow the business through cash flow, but for product company, you need some capital. And you have a couple of choices. You can go raise the institutional VC money, or you can raise some angel investors and friends and family. So we went that route. We didn't go and raise tens of millions of dollars from institutional investors, because I've seen that movie before and that didn't end very well. So we chose that, let's bring the right people who have patience, who believe in what we are doing, and who will come along on a journey with us. And as we build something valuable, they will be part of the success here.
Yeah, along my journey in my first agency, I didn't have a good grasp on the real effects of what I was doing with my capital and my cost of customer acquisition and payback period. And only looking backwards, I 5x'd my cost of customer acquisition and payback period in lieu of also 5xing prices. So I was horse trading money for money. It didn't really make any real economic sense. If you were to go back and talk to yourself in your previous companies, what were some of the pre-product market fit mistakes where you see people raise capital too early and they start deploying capital in non-accretive gains? Where would you talk to a younger founder to say, be very weary if you take capital? You're going to try to spend it this way, and it's not going to make sense.
Yeah. So I think there are two questions here: my learnings from my previous company, and then advice for a new founder, right? So look, I should have known better. I have had two successes in building a services company, a SaaS business, and then we went and raised almost $30 million to build a consumer technology product, right? A consumer technology business, and that did not succeed. The reason behind that is there are a lot of things that went wrong. And I have the whole video series on that. The number one thing is consumer technology companies are extremely hard to build, right? Therefore, you have only a handful of Facebook, Twitter, LinkedIn, Instagrams of the world, right? Number two, there's an ecosystem which exists in the Silicon Valley, right? And I was trying to build a consumer technology company in Washington, D.C., right? And it's no surprise that pretty much every big consumer company was either started, or if they started somewhere else, they ended up being in the Silicon Valley because of the ecosystem that exists there, right? Where they celebrate the failures, right? Where the investors have big banks and they understand that, you know what, we're going to make 10 bets and one of them is going to work out and it will be worth it, right? And then the third is related to ecosystem, but choosing your investors and your team members, right? Because the appetite for losing tens of millions of dollars when your fund size is, $1 billion is much higher than if your fund size is $150 million, right? And when things don't work, everybody dreams to build, whether it's the founder, the team, as well as the investors, they all dream to build the next Facebook, the next YouTube, right? The next Instagram, but they forget that the path leading up to that successful outcome is not a straight line, right? And along the way, you may lose a lot of money. So, choosing the right business model, choosing the right team, choosing the right ecosystem, choosing the right investors, those are all the mistakes that I made. Now, to your second part of the question, what advice would I have for the founders? I think that there are a few things. Number one, raising money is not bad, right? If you're building a valuable company, then it needs a lot of fuel to take, to get to the next level where you're building value for all the shareholders. But you have to prove that, yes, I am building a valuable company. Because everybody who starts a business feels that they're going to build a $1 billion company. But at the end of the day, the market has to dictate that is this company worth, or does this company have a potential to be a $1 billion company or not, right? So as savvy founders, you have to ensure that you get to that proof point as fast as you can before you take that money, right? Second thing, when you do take that capital from outsider, just know that it's no longer your company. It's no longer your company. You have somebody else who is dictating, right, what to do if you fail to execute on a plan that you shared with them, right?
Last question. And this is a quote from my entrepreneurship days in university. And the quote is, I want you to picture you wake up and you're 70-something years old. And you look at how much income you generated from your businesses. And it's 50% of the money you could have generated if you had worked at Apple, Amazon, a big institution. But you would have been a non-founder. You would have been an employee. Are you happy with that decision? Why or why not?
Yeah,
and that was the definition of entrepreneur.
Yeah, I wouldn't trade it for anything. I think the founders that start the company to get rich very seldom get rich. you have lots of examples of founders who set out to say, you know what, I'm going to make millions of dollars, and the success rate in startup is so low. But if you're passionate about building something from start, if you're passionate about putting all in to an idea and make a valuable business with like-minded people, then these hard journeys become fun. Otherwise, they can become very frustrating, because Apple can give you that $200,000-$300,000 paycheck consistently. The startup is not going to give you. Apple will give you the 3 weeks vacation. The startup, you may not have that luxury, right? Apple, you may have an EA working for you. The startup, you're working for everybody, even though your title is founder and CEO, right? So I think it's the right mindset of why am I starting a business that dictates everything. For me personally, I won't trade it for anything, right? This has been the fun experience. I've been an entrepreneur, all my life, professional life, and I plan to die as an entrepreneur.
Fantastic, love it. That was it. So I'm going to stop the recording.